Today we're talking about investment properties.
That's right. And we're going to talk a little bit about that quote that you and I were talking about the other day. Owning your own home doesn't make you wealthy, right?
Owning somebody else's does.
Yeah. And I think that's really important. In fact, the IRS reported that 71% of millionaires invested in real estate as a way of building their wealth, which I thought was pretty incredible.
That's staggering, actually. Here are some of the most common questions that we get on a day-to-day basis. So you go ahead and read the first one.
So one of the first questions were, how much of your own money is required to purchase investment properties?
For one thing, for any kind of investment property that you're going to be starting to make income from the very beginning, the minimum down payment is 20%, so that's something that you're at the least is going to have is 20%. Usually your terms and everything can be a little bit better if you do have more than your minimum down payment, such as like 25%. That is something that can help your terms, not necessarily required, but something to consider when you are looking for investment properties and how much of your own money is at least required as a minimum for that. Gift funds is some terminology, if you've bought homes before, is something that has been common for buying your primary residence. If you are buying an investment property, you cannot have any gift funds, so it's got to be your own funds.
And there is a way that you could go with a little less than 20% down, and that's with single family investments. So if it's single family, one family living in the home, that's what we call a single family residence. That's 15% down.
Right.
But it's the multi-units that Austin was talking about before that commonly people think of when investing. So multi-units means 2 units like a duplex or 4 units like a fourplex, and those ones want definitely 20% down.
Right.
25% down.
Right.
Another question. Have you ever borrowed money from one of your other properties to invest in another? It is common. Let's say house A is the home you live in and house B is the next one you're going to buy. And that one you're not going to live in, right? That's what defines non-owner occupied, which we were talking about earlier. So when the owner occupies versus the owner doesn't occupy. And the answer is that it is common that people borrow against their primary residence equity for their down payment in the next property.
Is that like a HELOC?
Yeah, so a HELOC is a home equity line of credit, and you can take those on your primary residence, right?
Only, right.
And you can't take those on investment properties, so you do need to plan ahead. It's better strategy to save the cash capital that you need for the next investment. However, the question was, can you borrow against one property for another?
Right.
Now, that's the most common, where it's primary residence borrowing to buy the next investment. Now, if you're like Jay, who's one of our friends, right? He owns 8.
He's the master.
And so some of his properties he owns free and clear. And again, he can borrow from those on a traditional loan to purchase another investment or to pay off another investment.
Sure. What are the common pitfalls I need to avoid when looking for an investment property? There could be a ton of different things that can really be what's called a pitfall. Really, I think location is really big as far as what is going to be the kind of investment property that I want to look at.
True.
Airbnbs, or am I going to look at a long-term lease? I think you were saying you live in Washington, you have an investment or a property that's in Florida.
Florida, correct, yeah.
Right.
So when it's at a distance, right, you do need to get somebody else involved as far as that goes for a property management firm.
Right.
But Austin lives here in Tennessee, so if he wanted to purchase his first investment property, he might do something more local to his neighborhood or his town that he lives in, or within, I think Jay said a rule of thumb was an hour, right?
Right. Somewhere you could get to quickly as far as, you being in close proximity to the home, especially with your first ones. There could be a ton of things that can happen, but you being there close is something that's going to be beneficial, obviously, in the long run.
Flips. Flipping homes means acquiring a home, let's say January of this year, and maybe turning it around within 3 to 6 months. That's a flip, right? Because we own and then sell in a short period of time. Common pitfalls are, if you're doing the work yourself, you need to know the amount of work that's going to go into it so you don't over budget, right? You don't want to spend too much and then not be able to sell the home for what you've now invested. Another thing is just what we talked about. It's just being skillful enough to do them yourselves or knowing when it's a good time to hire people out. And
everybody's different. So that's the thing, is if you are handy and you know that you could do a lot of the work, great, that's fine. But that could become a pitfall for some people.
Yeah. Austin, what would you say are the first steps and how do people get started?
Honestly, you need to get with your advisor to create some kind of a strategy that's going to fit your overall financial goals. It's a journey that no one is exactly the same. There's no such thing as a cookie cutter plan that's going to work for everybody.
Yeah. So please reach out to Churchill. We're here to help. We'd like to give you advice on your journey if you're looking to be an investor, whether that's your primary residence or a purchase after your primary residence. We're here to help you at each step of the way.
Love it. And make sure to like and subscribe, and make sure to follow any more content that we're going to be putting out.